Hi Mortgage Heroes, Andy Cruz here in Business Development, and this is Monday Mortgage Minute. Welcome back to a brand new week. Last week we had a huge batch of economic news which made a pretty big impact in the markets. You saw rates immediately go up when economic information came out. They did cool down a little bit on Thursday, but then they made a resurgence once again on Friday to retest their range highs. Well, we talked about some of this at the beginning of last week because we knew that we were going to get the producer price index and the CPI report out, and both of which were watched cautiously. The PPI number did come in at 8.5%, which was a little bit lower than the previous month, but no one was really cheering that on because everyone's attention immediately shifted to the CPI report, which came in higher than expected. Certainly not the reading the Fed wanted or needed to see. Well, the markets, despite being able to shake off massive selling when the number came out, it was able to rebound a little bit, but it sent mortgage rates soaring for a really short period of time, only to cool down later to kind of resettle itself at the most recent highs. In short, the volatility only provided a little overnight relief, but then we were right back to where we were 24 hours before. Once Friday opened, mortgage rates were back on the incline once again, like we've been talking about, doing exactly that continued upward trend with only moments or days of relief where rates dipped down into a more moderate price range, but then only to return in their course direction they were already on. So what does all this mean? Well, less than stellar news means that the Fed still has more runway to do increased rate hikes ahead. Coming into all these readings last week, they were thinking maybe there's going to be a 75 basis point hike in November. That's pretty much a lock now. There's some people floating it should be 100, but that just might be too much of a shock for the system. I'm not really sure because it was just a couple months ago they were saying we need to get to 4.5 Fed funds rate. Well, they didn't just race to it, but they identified they need to get there. So could they just do 75 next month? Maybe. They might do 100. It's less likely. But I think really in this data-driven market where they're so dependent on the most recent information, this is a really critical time in Q4 right now with earnings coming out, monetary pressure happening, you have elections coming up, plus you have gas and OPEC and the supply changing over on that side of the world of things. There's a lot of pressure on the Fed right now to make the right choice, and I think going 100 might be too much, but there's really no argument to say they're going to go less than 75. I also don't want to sit around and just say like, oh, well, we got to wait for another month's worth of data in order for them to make the right choice. I think they know what choices they have to make. I mean, their Fed meeting minutes also came out last week, and of course it did give some insight and some little more explanation as to what the heck they're looking at, but the problem is, despite all that, the numbers don't support a lot of the action that's already been taken. I mean, the first Fed hikes were made in March of 2022. And here we are in October, and we are yet to see the impact of those changes months down the road. So if they continue to make changes in the fall of 2022, at what point will we start to see those effects in the marketplace? Well, it's certainly not going to be any sooner than the beginning of 2023 if it's already taken this long right now. So for mortgages, that means mortgages are just going to continue to be under pressure. The mortgage-backed security market is only getting more expensive, and as the law of supply and demand predicates, when there's less of something, it becomes more expensive. So the less money there is flowing to the mortgage-backed security market, the more expensive it is to lend out. And of course, that then flows over to the cost of money to borrow right now. And that cost of money to borrow right now makes an impact on what people's personal affordability is when they're able to go and look for homes. What was just maybe 3% or 3.25% a couple months ago is now in the high 6s or low 7s, essentially doubling or a little bit more than doubling in a really short period of time. And we've never seen anything like this. In the 16 years that we've been doing this business, we've never seen a rate hike this aggressive and this quickly. And it is making everyone kind of reassess and readdress, okay, where do we need to be positioned in the market? How do we help people achieve homeownership? Who is it that we can still support in this marketplace? What do we do with homeowners who have lots of equity? How do we help people who are maybe on the verge of losing their jobs, but we don't want them to lose their home? All of these conversations are happening everywhere that's inside and around the housing industry. So here in San Diego, what I would expect is for competition to heat up. I mean, if we're on this trajectory where rates are just going to continue to retest their highs and maybe even continue going up, then I think buyers are going to be thinking, well, I better get that rate now, lock my loan now, get that house now before it becomes more expensive in December, January, or February. And I really can't blame them because until something fundamentally changes, there's really not an argument for the downside that rates are all of a sudden going to plummet and you're going to see house prices plummet at the same time. Those two things don't necessarily go hand in hand unless we're in really serious trouble. And of course, we don't want to get in serious trouble, but there is a growing sentiment amongst sellers and buyers that there's something going on in the marketplace that we have to pay very close attention to. And we're starting to see concessions on both sides of the table when it comes to buyers and sellers because the market is just calling for that. Some sellers are issuing buyer credits, some sellers are dropping their price, some sellers are paying for the 2-1 buy down on behalf of the buyer so that their monthly payment will be lower in the initial few years of owning the house. And I think we're likely to see more of that and a continuation of that until really the tide overall changes. So in conclusion, expect what we're dealing with right now to take its time to work through into corrective territory and for us to address the policy impacts that are happening at the macroeconomic level. This will not be an overnight change. This will not be an overnight shift. There is certainly no light switch that turns this thing on or off. All of these things happening right now will take time to work their way through the system, and we're going to have to go along with that, pay special close attention to it, and be very familiar with the intricacies of how that impacts home buyers when they're looking to buy and homeowners if they're looking to refinance. Plan ahead. If you have financial moves you need to make in 2023 or you have a physical move you need to make in 2023, plan ahead. I cannot state this more clearly. It is more imperative than ever that you plan your move next year right now. Do that in Q4. Do that knowing what we know now. Looking ahead, we don't have a crystal ball, but we can assess a little bit of what we think is going to happen, make some projections based on what is said, what is done, and what is seen, and looking at the specific markets that you're trying to buy a home in, or looking at the specific financial objectives you're trying to accomplish. Bottom line is get started now. There are many people you can connect with here at the office. You can connect with William, you can connect with Brian, you can connect with me. So depending on what situation you want to discuss or what goal you're trying to achieve, reach out to one of us. You can comment on this video, you can direct message us, you can even call, email, or reach us directly if that's easier for you. We want to make sure we can help you by sharing what is going on in the marketplace right now, our opinion and insight and perspective on what that means for you, and then what solutions might be available to you right now to achieve the goals that you have. So if you're watching this and maybe you're like not sure and you're like, I don't know if I should ask that question, I'm not sure if that's a smart question or not, I'm embarrassed to talk about what's going on, please reach out to us. Let us know how we can help you. Unless you step forward and tell us what's going on, it's really hard for us to know exactly what might help fix the situation that you're facing. So before we're unable to help you, let us figure out how we can help you today. The tide that we are all swimming in is going to continue to change through Q4. There's a lot of information still to come out for the rest of October, and then we're going to get into November and December, and there's just going to be a lot of moving parts, and it's not any more moving parts than it has been this year. It's just that the critical nature of them right now is going to be imperative for us to keep our finger on the pulse of, and then talk very clearly and communicatively to you, and you do that with us, so that those of you who are looking to move, those of you who are looking to finance, those of you who are looking to ease your financial burdens can get the best help possible. Also, you could be helping someone you care about and love by sharing this video. Forward this or maybe one of our other videos to them and let them know that we can help them out in their situation. If you have not yet subscribed to this channel, make sure you subscribe to the channel and you hit the notification bell so that every time we drop a new video, you see it first. As always, thank you so much for watching. We hope that you have a great week and we'll see you again next week.